All right, welcome back, people. Today I have an absolute rock star. I have Brandon Cobb with me, who is big into land development in general. Brandon, if you could just give us a brief background on who you are, what you're currently doing, and how that relates to real estate.
Yeah. First off, thanks for having me on. It's good to
Of
connect and,
course.
and be on the show. What we do is we take land and we get it approved for new housing neighborhoods. So if you told me 10 years ago that we'd be inventing these new housing communities, I'd have looked at you like you had 10 heads. There's three phases of development. Not a lot of people know that. Everyone just thinks, oh, you just buy a piece of land and throw a home up on it. There's a little bit more to it. We came into the industry as builders, looking to scale the number of homes that we were building. Right now, like I'm not building any homes because right now I'm just getting land approved and selling it to these big national home builders, which is the first phase of development. We call it entitlement. So first phase is entitlement. That's where we just take a piece of farmland and we get it approved for 50, 100, 200 homes and we sell it off once it's approved. So we force appreciate the value of the land by getting it approved for the development. And we don't buy it until we get that approval. That's a big risk mitigation thing. We put an option on the contract. We pay the seller more money than what it's worth, but they got to hang in there with us until we get it approved. The second part of development is where you go in, you make all the land flat, you grade it out, you put the sewer, the water, the utilities in it. You're basically creating a neighborhood with no homes. So the roads, all that fun stuff, and then we can sell the individual lots that are ready to be built to a big builder. So that's the second phase. And then, there's a third phase, which everyone's familiar with, which you actually build the home. So we do all three, but predominantly over the last few years since interest rates went up, we've put the brakes on building homes and we've just been getting land approved and sold to these big nationals.
Okay. So from what I understand, you had a different background from real estate prior to, and I believe that was medical sales, if I'm not mistaken. Is that correct?
Yeah, I was in medical device sales.
Gotcha. So, how did you pivot from medical devices and what was the exact moment you realized that real estate and specifically land development was your path?
Yeah, that's a great question. So I don't have this light bulb moment, and I didn't just pivot straight into land development. It's been a journey over the last decade. I was very passionate about what I did. I loved medical device sales. I was a young kid, mid-20s, wearing scrubs every single day to work. I thought I was the coolest kid on the block, rubbing shoulders with these successful orthopedic surgeons. I was selling a product I believed in that changes a patient's life for the better. I was in the OR every single day. I was very intimately involved in the surgery and training the hospital staff on my product to make sure the patient got the best possible outcome. And one Friday afternoon at the Starbucks over in Weston and Nashville, I got fired from my job unexpectedly. I thought that everything was fine and it wasn't. So that day I learned a very valuable lesson, which was nobody was going to look out for my financial well-being but me. You can, work for a company for decades, climb the corporate ladder. Doesn't matter. You're just one merger and acquisition, restructuring, economic event from losing your job. And so that's what started my entrepreneur journey. At first, I had multiple businesses that failed. I started a course on how to break into medical device sales because I thought, well, a lot of guys have asked me how to do that. Maybe that's what I'll do. That failed. I started a online motivational blog because I was into that kind of stuff. It failed. I said, I really like the Tony Robbins stuff. Maybe I'll be a life coach. And Ton, you're not going to believe this, but not many people want to take life advice from a 26-year-old. So that failed. But then, as you know, I discovered this amazing vehicle called real estate, and I went all in. At first, I made all the mistakes, lost lots of money. I sold all my retirement accounts to invest in real estate. Don't do that, by the way. This is not financial advice. I didn't know that you could use a self-directed account to invest. Stupid. Racked up $98,000 of credit card debt. I mean, every mistake you could possibly make, I made. But over the course of a number of years, I did, close to 200 plus transactions. I learned this game. I learned how to make money. And I built a business where we're flipping about 30, 35 houses a year. Eventually, I started building houses because I made 3 times the amount of money on one of my new builds as I did flipping houses. And that was the first light bulb moment. I said, why am I flipping houses? I should be building. And then we were doing a lot of infill builds, which means these like little vacant lots between two homes in a pre-existing neighborhood. And we got sick and tired of being so spread out among all of our projects. We said, man, if we're going to build 30 homes a year, why be all spread out? Why not do it in one or two parcels of land that we can do 30 houses on? And so that was the second light bulb moment, is it's just as easy to talk to somebody who has a piece of land that you can build 30 houses on as someone who has a piece of land that you can build one or two. So we started going after those types of projects, and we got these knocks on the door from these big national home builders and said, hey, we want to buy your property. And they were offering us a ridiculous amount of money for it. So we said yes. And that's how we kind of got into the land development game. So it's been a little bit of a journey, as you probably see.
Got it. And I want to talk about some of your lessons, but firstly, a lot of our listeners are mainly value add in multifamily or structures that have already as built, right? So for someone who's never touched raw land because it feels too risky, could you elaborate a little bit further on what land entitlement is?
Land entitlement is the process to take a piece of land and get it approved for a new community. You can't just go buy a piece of farmland and start building houses. That's not how it works. The city has to approve that development. And so you have to go through multiple departments that have to bless the development and say this is safe in order to get approved. Think of it like this. Every community we have is designed where the stormwater runs around it. The grading is a certain way, it feeds into the streams. The fire hydrants are so many distances apart. When you're getting a community approved, every department in the city has to approve it. That's their job, is to make sure the community's safe. And so when your civil drawings, which is the design of the community, goes to the fire department, they're looking at, okay, did you put fire hydrants every 120 feet? Are the houses being built too close to the power lines? Stuff like that. When it goes to the public works, they're saying, okay, do we have curbs in here? Do we have proper drainage? Are the roads more than 8% incline? Stuff like that. Stormwater. Is the water going to flow around the community? So every department is looking at it with a magnifying glass, making sure that it's a safe community. That's what entitlement is.
In that process, what are the early tell signs at whichever level? It could be at the municipality, zoning, utility, etc., that tells you that a single piece of land is truly ripe or perfect for a development versus a money pit that looks like an opportunity?
So this is our process. Very simple. We've got a process for how to target the right land. And if you want to know what that is, you can go to learnlanddevelopment.com. We have a free course. Go grab it. It shows everything that I'm going to explain here. I'm not going to go into how to target the land. You can go find that on the free course. We get the land under contract. We get what's called a concept plan done. This is just a sketch on what we want to put on the land. And a civil engineer can get you this. So it's a 2D sketch of all the little rooftops on this piece of land that you want to buy. We take that concept plan to the city and we say, hey, do you want this? Is this something you'd be excited about? And if they raise their hand and go, heck yes, like yes, or they may go, let's make some changes here and there, and then yes, we'll be excited about it. We then take that concept plan to our list of buyers, these big national builders, and go, look at what I got. I got something the city's excited about. Would you buy this if I get it approved? And if they give us a contract and a deposit, we're in business, baby. We're taking that thing through. Now, the DD on the land. While we're in our due diligence period, we're going to get 3 big things done to make sure that we don't run into a problem. Number 1 is a geotech report. We need to make sure that we've got soils that are good to build on. You want to make sure there's no sinkholes or whatever that's going to throw a wrench in things. The second is a phase 1 environmental. We're going to test the soils. Was this a toxic dumping site for something? Are we going to have these Godzillas that are nuclear waste activated they're going to come out of this thing or whatever? It's going to make sure that the land is safe. And then the third is an endangered species report. We want to make sure we're not cutting down any trees where there's bald eagles and we're causing felonies, right? If you do those 3 DD items, and everything comes back, you're pretty safe at that point as far as issues with the land. And then, of course, there's some stuff that the city might make you do, Maybe they want to see a traffic study to see how you're going to impact things. Maybe they want to see a hydrological study done from a civil engineer just to make sure that the water is going to flow the right way. And so those are some of the things that we do during the DD period just to make sure the land is going to be safe to do this with.
Got it. So when you find a piece of land, you actually have to have a lot of clauses and contingencies that are within that contract in order to play this thing out as you get a civil engineer involved, get some of these reports involved. Well, that's in DD, yeah, when you're in DD, while also communicating with the municipality to get all these things falling into place. Is that correct?
Yes. So we don't buy anything until we get the approval. That's just what it is. I'm not buying anything up front at all. We put an option on it and we say, hey, Mr. Seller, we're offering you a lot more money than what the land's worth. In order for me to give this to you, you need to hang in there with me for 12 to 18 months. I got to get the approvals because your land's not worth what I'm currently paying you for it. But if you hang in there, you'll get a lot more money.
Right. So then you mentioned a second phase after the entitlement process where it's essentially grading the land, getting it flat, and bringing the utilities to the land. Is that correct? Could you elaborate a little bit more on that piece?
Yeah, that's the second phase. After you have your approvals and you've forced appreciate it, you can just sell the paper. You don't have to do any construction at all. But if you want to, we will get a contract from a builder, and they'll say, hey, Brandon, I got a development right now. We're selling it for $7.6 million. It's 74 lots. And they said, hey, here's a deposit. We're going to give you an $800,000 deposit. Here you go, free money. So I get that money. I use it towards the development. And we will then develop the site and deliver ready-to-build home sites. So the roads are in, the utilities are in. All they got to do is just build their home, hook up to it, and go vertical.
Okay. So let's talk a little bit about the lessons that you've had previously. You mentioned you've lost a ton of money on a deal in the past. I guess what were some of the specific assumptions that you had that could have broke with that particular deal? And what would you do differently if you saw that same deal today?
Yeah. So golden rule, don't buy it until you have the approvals. That's where I lost the money. So we bought something prematurely because we thought it was a great deal. And then we didn't get what we wanted on it. And then we didn't have a good civil drawing set that was designed. And the cost ended up being 3 times as much money as we thought. So we went way too quick. We should have pumped the brakes and waited to get the approval, waited to get the final design, budgeted everything out based on that final design plan, and then move forward with the deal. And yeah, that was a tough one to stomach.
So let's talk about the flip side. I'm sure you've had a ton of wins, and in particular, I think I've heard you've had over $1 million win somewhere. Was that skill? Was that timing? Or some type of process or systems that was repeatable?
Yeah, so on that one, that was, again, understanding the market. We kind of got lucky with that one. It was a builder who was coming in hot and heavy in the market, really needed to get some product. And that was one of our first deals that we did, where they just offered us a crazy amount of money, and we're like, heck yeah, like we'll do it for you. They really wanted finished, ready to build pads, and that's what we were doing. We were going to build the homes, but we had done all the development already, and they came in, really wanted the pads, and so they offered us a crazy amount of money, and we said, yeah, we'll just sell you the finished, ready-to-build pads, and you can be the one to build the homes right there. So there was a little bit of luck involved with that. We were actually going to build the homes, but we instead chose to just sell off the pads.
Gotcha. Now, within the 3 phases of the land development process, where do you see the highest margins within those 3 steps?
You're always going to have the highest margins when you build the house, right? That's where you're going to make the most money. But there's also the time value of money, right? You don't want to wait. Like, if it takes you a year to get the approvals, 15 months, 18 months, and then another 15 months to develop the lots, and then another 8 months to build the houses, you're looking at 3 years. So you might not want to wait that long to get your money. What we do is the entitlement company, the holdings company, will entitle it, sell it to the entity that's going to do the development, and that way we can squeeze out some of that profit for ourselves, that work that entity's done, the entitlement, at a fair market value, and sell it to the other company. You got to figure out ways to free up cash flow. So the entitlement, that's going to cost you the least amount of money, you're also going to make the least amount of margins. We make anywhere between $5,000 and $15,000 per unit on the entitlement portion. If we're developing it, I want to make $20,000-$30,000 per pad at least on something like that. That's after we got the entitlement profit. And then if you build the houses, if I'm building a $500,000 home, I want to make $80,000 on that new build. And so that's $80,000 per unit. And so that kind of gives you an idea of what the margins look like on each individual phase of the development.
Gotcha. Okay, so let's look at the land in and of itself. One, how are you sourcing your deals, and what your land deals in particular, and what makes that particular land just absolutely look like a home run? Like, for a fact this plot is fantastic for a developer. Like, what metrics are you looking at to determine that?
We reverse engineer what our buyers want. So what I'm about to tell you works for any real estate niche. You don't have to be selling neighborhoods to national home builders. If you're using self-storage or multifamily or commercial, whatever it is, this is the same process. It works for any type of real estate. We start with where our buyers want to be. So if you go type in Lennar, Nashville, Tennessee, D.R. Horton, Nashville, Tennessee, you can see a map of their neighborhoods on their website. And we just go to the areas that they're already building because we know that that's where they want to be. There's software programs that can do this too. And we're looking for large parcels of land that are around all the small parcels of land. So if you ever pulled up a GIS parcel viewer, so every county has like a GIS parcel viewer where you can see all the parcels of land. They all fit together. It's a giant puzzle, and all the land parcels are little puzzle pieces that fit together. I'm looking for the giant puzzle pieces that are down the road to the developments. And you can see the developments because there's a lot of little bitty puzzle pieces on the developments, right? All those little bitty lots that are created. So I'm looking for the giant puzzle pieces that are in and around the small high density puzzle pieces. That would be the best way to explain it. We then pull the sewer maps. So we reach out to the local utility department after we've got a parcel that is interesting, and we see how far away the sewer is. The sewer is important because that gets you density. If you have sewer access, you can put these 5,000, 6,000, 10,000 square foot lots on there. If you don't have sewer access, you have to have a septic system. That septic system has field lines that dispose of the waste using the land. And so it distributes the waste. That's what a septic system does. And if you're going to use a septic system to distribute the waste into the land, you need more land. So you're not going to get as much density with a septic system. So that's why we pull the sewer maps. If you've got large parcel of land with sewer access, with developments in and around the area, you're kind of in business. The next thing I look at is the topography. And there's apps that cost nothing that allow you to do this. We use LandGlide, we use Land ID. They're a couple bucks a month. But what does the topography look like? Is this a cliff? Right? Is it a giant cliff? Is it a mountain? Is there a mountain on the property? I'm looking on Google Maps. Okay, if it's relatively flat, okay, good. We're in business. If I see a mountain or it just falls off a cliff, well, it's going to be kind of hard to develop that. That's the initial due diligence. What we've done to make it easy is we've got a land due diligence agent in our community, and we give away that land due diligence agent, and it just spits out the reports for everybody. It saves 4 or 5 hours of due diligence. So you can use AI to be able to create these reports for you as well.
Beautiful, beautiful. So let's talk a little bit about the underwriting of land, because you really don't have any income coming in. So when you're developing it, what line items do, I guess, a newbie like myself consistently underestimate? Is it soft costs, carry costs, fees, etc.?
Yeah. No matter how many of these you do, there's going to be some stuff on the budget that gets missed. I've never had a project that was like perfectly smack dab. We nailed every cost to the T. So you're going to have some stuff that you kind of have to estimate, like rock contingency. Make sure you've got a rock contingency, because you can get a geotech report, and that geotech report, they're going to drill in all the areas that you're going to lay pipe, the lowest part of your development, and see if you run into anything. I had a clean geotech report. We still ran into rock. Cost me $75,000 to get it removed. I mean, it is what it is. You got to have a rock contingency. That's probably the number one. The other is your holding costs. Make sure that you've got that baked in. Your holding costs. These projects are weather dependent. They always take longer than you think. So make sure you've got your holding costs accurately baked into this thing. Those are going to be the two big ones. If you've got solid contracts in place with your subcontractors on this job or your GC, that's going to be really important. The other thing that can move around on you are the impact fees with the city. We had a project where the city quoted us a certain price for the transformers, or actually the city provided the transformers. We didn't have to. And then during the last phase of development, they go, hey, just kidding. We're no longer giving away transformers. You have to pay for them. What are you going to do there? So the city is a big pain in the butt, and it's their world, and you sort of live in it. But getting that in writing from the city, you know, what they're going to provide. I had a project we thought was going to be one-phase electric. Ended up being three-phase electric. You know, that was a $170,000 mistake. Again, that was on the city telling us the wrong thing. You know, annoying, but what are you going to do? I got to have three-phase for this project. I just make sure you're building in a 10% budget contingency, and you should be okay.
Sure. On the business front, you know, with these three levels or three phases of the development piece, you have to have a team that is really good at the processes within each phase. And obviously one of them being the build up, the construction piece, right? So how do you manage, I guess, three different facets of three different businesses at the same time?
So if we're doing development, what I love about this business, this development business, you don't have to have a huge team and a ton of overhead. I've run that business before. My overhead was higher when we were flipping 35 houses a year than it is when we're developing, you know, $20 million a year in development, because I can outsource the big things. A civil engineer is going to design the whole thing. I'm going to pay him to do that. That's his business, not mine. That's his overhead. He's going to design it. A GC, a contractor, is going to do my whole development. Now, we run everything through our construction company, and we manage the GCs that we manage, but most of the overhead is outsourced to them, and we manage them. A-plus opportunities attract A-plus talent. These big $5-10 million developments is a lot of money, and these GCs make a lot of money doing these. You get a different level of talent that you do versus back when I was like flipping, you know, houses and, you know, dealing with those types of contractors. So all that's outsourced there as well. You know, the city, they're going to approve everything. So you need a face. My partner, he's the face of the company and getting the approvals in place. So you don't have to have a huge team. You need a sales rep. Excuse me, I sneezed there. And if you've got just the basic foundation in place, you're good. You know, we've got a capital raising company. You're going to need to be able to raise money. So, you know, I've got a person that helps me, an assistant in the capital raising company, but I'm kind of the face. And so that's what I like about it is I only need to do 1 or 2 deals a year. I don't have to have a ton of overhead. AI is automating most of what we do anyway, which is amazing. And it's just a really good business model to be in. But your point about the cash flow, you have to have cash flow, because it will take a while for you to be able to generate something. So if we are doing a development, our construction company is going to make a little bit of money on every draw, right? It's because we're managing the project. We're going to make, 5% on top of the costs. That's cash flow during the life of the project. When we get it entitled and sold to the company that's developing it, we're going to make money on that entitlement piece. So you've got to have some kind of cash flow coming in to be able to be in the development business. And so we've got other businesses. Our construction company does jobs for other people. We've got some cash flow coming in from that. We've got some other sources that provide cash flow, but cash flow is king. I tell people, like, this is not a good fit if you're a W-2 person looking for a side gig. Like, this isn't it. This is a really good fit for an entrepreneur who's got a mature real estate business. They've probably done multiple types of real estate, and they want to add development as a wealth generating tool to it, right? Your cash flow is great. You're not going to get any cash flow from development unless you structure it the right way, but you'll get these really big wealth hits that are absolutely, life-changing.
Yeah, and I'm sure they're really happy with that. But let's pivot to the capital raising piece for a second. A lot of us that are, the audience of Wonton Wealth, or myself included, being an operator in the commercial space, when we are raising capital for our deals cash flow from day one, and we play the value add piece or the appreciation piece, and then that's where the investors see the enticing benefits of getting that value add and hitting the payday when you sell the asset, or you increase the cash flow in some way, shape, or form. So the education for us is pretty simple there, just kind of letting them know what the asset is and when you get your money, etc. So for a land development piece, they're not making any cash flow for X amount of time, in some cases, possibly even 3 years. Aside from that aspect, are there any other big hurdles when you're communicating with these LPs and investors that are going into your deals?
Yeah, I mean, we're transparent about it up front. It's not, the cash flow is not a hurdle because we just communicate how our business model works. And if it's not a fit for what they're wanting, then we just don't do business, right? And so we've got very strong preferred returns. It is a big diversification play. People like the risk profile because a lot of these are pre-sold. So we're not doing any speculative type investments. Investors are walking into an asset where the forced appreciation is there before they invest. So a little bit different than multifamily, where you're force appreciating, and after you renovate it and after you stabilize it and after you increase the rents, that's where the value is created. We create the value before the money goes into it. And we're creating a lot of equity when we take it from farmland to 85 home community. And that gives the investor a equity cushion on their investment. So we walk through that. There's no depreciation. That's a huge benefit. I'm a big multifamily fan, big commercial fan, because you get the depreciation benefits. You can't depreciate land, so not a good fit there. And then we walk them through some of the benefits. There's no cash flow. Obviously, if that's something that you want, go somewhere else. I haven't gotten any cash flow from all my multifamily investments. I'm an LP in for the past 2.5 years. So, there's that. So things can kind of go wrong, but yeah, we make sure that there's an alignment there and a fit before we do business.
Got it. And how do you structure your deals with your investors now for these land deals?
Yeah, so we do a straight preferred return. It's a 100% waterfall to the investors till they get their money, and then their preferred return, and then they're basically out of the deal, and then we have 100% upside for ours. It aligns the incentives with the GP partners and the investors. So that's most of what we've done. We've done some odds and ends stuff there, just with some various high net worth individuals that can bring all the money to the table, stuff like that. But I'm a big fan of not going to the bank and getting debt. I would prefer to work with private individuals, private companies, where I can get the terms that I want. I'm fine paying a higher interest rate, but again, the risk, you want to mitigate the risk. And what I've seen with these banks is, they can call your note due. They're not as negotiable on the terms. Yeah, you get a lower rate, but they can there's a lot of risk there. And I try to really circumvent the risk.
Got it. Two things here. What's the split with you as the GP and the LP? Is it a 50-50 split, 70-30? What does that look like?
There's no split. They get a preferred. No, so in the past, past performance is no indication of future results. I got to say that, but we've done an 18% preferred return, and they're out of the deal.
I see. Okay, that's interesting. And your private funders, are these like family offices, or obviously not banks?
Yeah, no, we've never done anything with family offices or institution. It's all been just mom and pop private investors, and then private lending sources.
Got it. And how, I guess, for, let's say, your most recent deal, how many individuals or investors are in these deals with you?
I've had one investor bring all the money, and so we did a debt deal with him. I've done deals like that. If you've got that balance sheet and you've got that much money, we can do deals like that. I've had 15 people in a deal, raised a couple $1 million in equity. Did a $10 million development, went and sourced, $7-8 million of debt on top. So it just varies. But our typical capital raise is like $1 million, couple $1 million if we're doing a development. If it's for an entitlement project, it's pretty low. It's usually like $200,000 to $500,000 if we're just raising money to do an entitlement deal.
So it varies when when it changes between the type of investment we're doing or development that we're doing, and it goes either from equity or debt. So it just depends on the project, right? Got it. So aside from developing land for home builders, have you developed land for any other asset classes?
We've done some mixed use stuff that's had some commercial sprinkled in. Looked at some industrial, but mainly what we focus on is single family residential. Sometimes there'll be some stuff attached to that. I looked at a parcel yesterday that's got some nice commercial on the front of the property. But yeah, so every now and then we'll get some stuff mixed in, but the bulk of what we do is single family residential neighborhoods.
So when you do the mixed use with some commercial in there, whether it be industrial or retail, are you running into any issues with the city when you're trying to entitle the land?
No, in fact, commercial is a huge benefit because the city makes their money off of the taxes on the business's transactions. So every time you do business with a local business, the city gets a cut of that. Look at your receipt, look at the city tax on there. They love commercial. All the cities want commercial more than they want residential. In fact, one of the main reasons why they approve new communities is to create more rooftops that lead to more commercial businesses.
Right, right. Now, I know you mentioned you reverse engineer the land that you're finding for the home builders, right? Are there any other data points that you look at within a market or a sub-market that looks completely ideal to you? Let's say, a land builder isn't even in this market, but you find a plot of land that's, farmland, and it's huge, and there you see some potential. I'm trying to figure out if there's any data outside of where the home builders are that could make it ideal for someone who's looking for land.
If it's in an untapped area, if I've got a relationship with my builders and they say that they want to be in a certain area, okay, I'll go and focus there. But that's the key thing. There's got to be development nearby. That shows that they're approving it, and that shows that the builders are having success with their neighborhoods. They're getting the absorption that they want. The other things to consider, though, is the municipality developer friendly or not? And what does the approval process look like? I'm not going to California. I don't want to do any developments in California because it's like 4 or 5 years to get something approved there, and God knows what you're going to have to jump through. Heck no. So picking areas that are developer friendly. COVID kind of revealed this environment that we all knew was there. We have business friendly states. We've got non-business friendly states. And there is tens and tens of billions of dollars that have moved to the business friendly states since COVID happened. States like Florida, Texas, Tennessee, very business friendly. Low taxes. We don't have any income taxes here in Tennessee. So you want to go somewhere where the municipalities are developer and business friendly.
So in short, you're saying to continue to reverse engineering and finding where the development pieces are and then kind of figuring out what they want and then catering that to them. Got it. So if we're looking forward, where do you see, let's say we're staying on the single family home piece for development. Is there a point in the future where, it's just going to be oversaturated? And I'm saying that along with multifamily as well.
We're always going to need homes, that's not going away. We're short 3 to 6 million homes. You've probably heard it. There's an affordable housing crisis. If you look, it's almost never been more expensive to own a house than it is to rent right now. It's crazy. Go Google the rent versus own price chart historic, and you can see it'll show you the delta on like what the average mortgage is over the last 30 years versus what the average rent is. And it's crazy to see the gap. That's not going away. So we've got an affordability problem. And most people think, well, why don't we just build more homes? Most people don't realize, well, it takes you 6 months to find the land, a year and a half to get the entitlements approved, another year to do the development, and then another 7-8 months to build the homes. So that's 3.5 years to get product to the market. It just takes a while. So I just don't see that going away. Right now, we've got the millennials that are the babies of the baby boom generation, right? So you have a massive influx of a new demographic that has entered the home market, as of 4, 5, 6 years ago. They're having babies, they're settling down, they want to buy. 33% of the home buying population are millennials. Less than 10% of the homes being built are entry-level housing, affordable housing, that $1,800 to $2,200 per month product. So we've got a supply and demand imbalance that it's hard to see it disappearing anytime soon.
And you're seeing that nationwide, not just Tennessee, yes?
Yeah. Yeah. Oh, yeah.
Wow.
It's nationwide. And of course, it's worse in certain areas than others.
How do you see the multifamily market doing right now? Because I see a lot of development in multifamily in general, and I have a lot of friends that are operators in the multifamily space, and a lot of their deals are not penciling out, nor are they, they're actually going underwater. So it looks like multifamily's in trouble, and I've seen properties that are in some of the bigger metros, call it Phoenix, right, DFW, or some of the bigger markets in Florida, and if you just do a quick search for these assets, it looks like they're 50% vacant and they're offering a ton of concessions. So I guess for a developer that's in the multifamily space, what would you tell them? Or, what is the data saying?
Yeah, I'm not like a data analyst when it comes to the multifamily stuff. It's been rough. I'm an LP in multifamily deals. I'm not getting any cash flow. I've had capital calls. I've had losses on the investment. It's been brutal because you're pigeonholed into one exit, and everybody got caught in this bridge debt environment. And what can you do when your mortgage doubles on you? There's not a whole lot you can do. Your options are very, very limited. There's a lot of distress in new construction development. I've seen that. Ken McElroy, he's kind of leading figure on this stuff. If you're into data, go watch his YouTube channel. His stuff is awesome. I keep up with it. He's talking about how more distress is to come. Wait for it. And it's going to be a fantastic time to buy property, especially these developers that built this multifamily, got caught in everything, and now they have to sell. So I think it's going to be a great time to buy multifamily. Right now, I think is a great time to buy multifamily. So as far as the data goes on it, you would think with how expensive housing is that we would have seen more pressure to increase rent prices, but we haven't. We've had rent compression, but I think the sentiment is that that's over with, and we're going to see rents continue to rise. You've got a dovish Fed chair, or what everybody assumes is a dovish Fed chair, Kevin Warsh, that's coming in. We're all expecting rates to go down. I don't know how they can't lower rates. They've got $9 trillion of debt to roll, and they don't want to roll it at the current rate. So I feel like they're forced to lower the interest rates to refinance the national debts. So I think that's coming. What does that mean for inflation? Probably means inflation is going to come back. So what does that mean for multifamily? It means, higher asset prices. So we're entering a crazy little world where you have these massive forces that are pushing on each other, and it's kind of hard to see where the puck's going.
Agreed. I have no idea, but I do hear from a lot of people that multifamily is probably going to be the best next buy here within the next 2 years or so, or probably even now, right? Some of these underwater assets and whatnot. But I guess the supply out there, though, with these going under, you don't see a lot of developers developing multifamily, do you? I still see some that are building Class A multifamily out there.
Yeah, it's Class A. Yeah, everyone was building Class A, and again, there was an absorption problem and an oversupply, and I don't know if that's trickled off yet and if that's stabilized, but yeah, I just don't see a lot of people that have been building new, but that's kind of your opportunity, right? Because you're going to ride out that wave where all the inventory gets flushed out by the time you do start building, if you build now, and then you're going to be the only game in town.
Yeah, 100%. But Brandon, so what's next for you? And I guess how can the audience or the listener add value to you?
Yeah, so we're trying to get from 22 million to 100 million. A lot of things have to happen in order to get there. But there's two people that we serve. So if you are somebody that wants to learn how to do this, if you are a builder looking to scale, or a land flipper that maybe wants to get in some larger land deals, or maybe you're just a real estate entrepreneur that wants to get into development and wants to supercharge your business with all the stuff we're using with AI and get the blueprint to not make all the same mistakes that we made, you can go to learnlanddevelopment.com. Go grab our free course on the website. There's also a video if you like the idea of being part of a mastermind community of other people who are doing development and you like the idea of getting your hand held through your first deal. There's a video, go watch it. You can book a call with us, see if it's a fit. If you're an investor and you're interested in investing in, pre-sold development deals to big builders, you can go to hbgcapital.net/waitlist. So that's pronounced Harry Bob Gary, hbgcapital.net/waitlist. And you can watch our investment thesis video. And if you like what you hear, you can book a call. If you want to get our free ebook, 100 Questions Business Owners Ask Before Investing, you can go to hbgcapital.net. So no wait list on the end of that one, just the regular hbgcapital.net. And we've also got a podcast, Recession Resistant Real Estate Radio. You can listen to us there.
I love that. Well, that's all the questions I had for you, Brandon. Before you head out, are there any other links or personal social media things that you want to leave the audience with?
I'm on all the social media channels. My name's Brandon Cobb, like corn on the cob. So go check me out on LinkedIn, Facebook, Instagram. I'm on TikTok, all that stuff. I do free content just about every single day. So go check it out.
I love that. I'll have all that in the show notes. Brandon, appreciate you joining us today. Appreciate your time.
Thanks, man. I appreciate it.